Hi, everyone. Can you hear me? I'm hoping you can. Welcome. Today is March 19th, 2020. And I'm here today because we have seen extreme volatility, and we have a lot of people who are very interested in knowing what this means. I'm going to start admitting people. I'm sorry. This is a new platform for me. So hang on. I didn't realize I had to admit you. Maybe next time I won't have to admit you and you can just join. Anyway, so welcome, welcome, welcome. I'm going to dig right in first and talk about what's going on. And then I'm going to address a few questions that have already come in. If you have a question at the end, then you probably are going to need to type it. I apologize that I am not, like a super Zoom woman yet, but I get the feeling that over the next week I will be. So the first thing to note is that the markets have been down as low as 32%. They're down about 29% right now. And that's the fastest that the US has ever gone from a bull market to a bear market. So this is unique circumstances. I also, I know you guys don't read the Fed minutes as much as I do, but I think it's important, and I do want to just give you a quote. This is from Jerome Powell. So financial conditions have tightened markedly. The cost of credit has gone up for all but the strongest of borrowers. He also said that several important financial markets, including the market for US Treasury securities, have at times shown signs of stress and impaired liquidity. So he has begun they've been putting more capital into the system. They've begun buying treasuries. They've begun buying mortgage-backed securities. What does that mean for you? I think that what you need to understand is that if you wait for the headlines on what that means, it's going to be too late to protect yourself. And I'm going to talk a little bit about why that's the case and what you need to be looking for, and then how you can protect yourself. So again, the markets are down 29% as of today. That's definitely in bear market territory. The question a lot of people are asking, which every economist that I've been listening to has all been saying that yes, there will be a recession. In fact, we probably have already started the recession. They're predicting, JPM has a chart, they're predicting that will contract 1.9% on the year. That'll be about 4.5% in the first quarter, about 14% in the second quarter. So the first and second quarters are supposed to be the most severe. They're predicting after the virus crisis is over that we will start recovering pretty fast, but it will still mean a 2020 recession. So that's the economists predicting that. Of course, it doesn't take an economist to see that that's happening. And why is that? Well, 70% of our GDP, our economy, our economic growth is consumer spending. And if nobody is out there, all the retail stores are closed, and the only thing that we're really buying are consumer staples, that's going to be a big hit to our economy. So I want to remind you on the optimistic front, the losses have been extreme, 29%. That means that it's wiped out everything since 2017. But, that's the good news. It's not wiped out everything that you've ever had. We had a good rally between 2017 and 2020, and now that's wiped out. But I do also want to sober you up and remind you that they're saying, oh, well, this is more like the dot-com recession rather than the Great Recession. Look, the truth is they really don't know what it's going to be more like because the crisis isn't over yet. But the fact that they're referring to those two recessions should be alarming to you, because the dot-com recession cost NASDAQ composite index investors 78%, and it took 15 years to crawl back to the March 2000 highs. And then the Dow Jones, the Great Recession, the Dow Jones dropped 55%. So, you know, you really don't want to be on that kind of Wall Street roller coaster. And I want to remind you that the solutions are very simple. If you were 50 and you were overweighting safe, so you're always supposed to keep a percent equal to your age safe. And I'm going to talk about what's safe briefly in just a moment. You're always supposed to be having at least a percent equal to your age safe. And you do need to know what's safe in a world where stocks and bonds and both are losing money, bonds as well. Usually bonds earn gains in recessions. So you really need to know you know, what's safe in a world where bonds are losing money, and also where money market funds have redemption gates and liquidity fees. So there's a lot to learn. You have to be informed. You have to be the boss of your money. However, it really is easy. It's the ABCs of money that we all should have received in high school. And I want to remind you that if you were 50 and you were simply overweighting 20% safe, which is something that I've been recommending for a while, then you would have only 10% losses instead of 30% losses at this point. All right, so we've talked about the data. We talked about the money drying up on Wall Street. And this is a crisis on Wall Street. And the reason for that, it's something else that I've been talking about for a while, is that there's too much debt in the world. There's too much debt in the corporations. There's too much debt in the federal government. There's too much debt in consumers. There's unaffordable housing. So all of the indicators that were a problem before the Great Recession are more problematic today than they were before the Great Recession. So, you know, you can't just go by it saying, oh, real estate prices are high. Oh, stock market prices are high. It's really good when we have that kind of economic recovery and you feel like you're rich again. But if you're just going to lose it because it's a bubble, then it's not really good. So you want to make sure that your plan is not riding the Wall Street roller coaster, that you have a plan that's capturing gains, that you have a plan that's properly diversified, and that you know what's safe in a world where, again, money market funds have redemption gates and liquidity fees. And I think you better know what that means, because it's a bank bail-in plan on your dime. And if you haven't read the fine print, you're going to be pretty upset if that rule applies to you. All right, so I want to talk a little bit about strategy. You need to be careful of bad advice. I am seeing, look, right now, all of the things that I'm talking to you about, they're not going to be the things that are mentioned the most on television. And the reason for that is that part of what needs to get us through this crisis is a focus on health and social distancing and all the things that they want to do, because the first thing out of the crisis is that we don't have a huge amount of loss of life. We don't overwhelm our hospitals. So rightfully, the focus is going to be on keeping us healthy, and that should be your focus too. The other reason that you're not going to hear what I'm talking about on the headlines, look, I saw this before the dot-com recession. I saw it before the Great Recession, is that it's just not going to be something that the producers want to put on air. I've been wanting to warn about certain things, and, you know, I'm able to sometimes slip it in, but usually they want to hear the positive stories rather than the negative stories. They want to wait until it happens to tell you. And again, if you wait for the headlines that it happens, then it's going to be too late to act. As an example, we will not know that we are in a recession technically until we have 2 quarters of negative growth. So we won't know that, we won't get the announcement that we're in a recession until the economic GDP report that is released at the end of July. But if you wait until that happens and then everybody freaks out that we had negative 14% GDP growth, which is going to be an alarming number if that's what it turns out to be, then you're going to be catching a falling knife again. This one caught everybody off guard. It's something I've been warning about for a while. And again, the coronavirus is obviously much more dramatic event than any of us were planning for. But the problem was also that we were very over leveraged. So nobody had the resources to get through it. American households didn't have the resources because consumer debt is at 14 trillion. Corporations didn't have the resources because too many of them are just above junk bond status. And when the cash crunch came and the feds had to step in, there was no money for them. So be careful of bad advice, because what I'm seeing a lot of is a lot of articles and a lot of television segments that are promoting either buy and hold or buy on the bounce, or all the billionaires that are buying low. The better strategy is at this point to make sure that you're actually protected. So you need to have the nest egg pie chart system in place. I would still be overweighting 20% safe. And the nest egg pie chart system, the reason that you put your holdings into the nest egg pie chart system rather than just working off of your brokerage statements is that it takes the emotions out of it, and it provides you with better information from which to do your rebalancing. So if you feel like you don't have enough safe, now is the time to be rebalancing. But the first step of that would actually be to put your holdings into a pie chart format, so that then you can easily see, oh, look at that, I have this gigantic slice of large cap value. I should trim it back to the slice I should have. And by the way, I do have free web apps so that you can see a sample pie chart of what you should have based on your age and overweighting safe. All you have to do to access that is just go to the homepage at nataliepace.com and click on that badge for the free web apps. So you can personalize the pie chart of what you should have. Personalizing the pie chart of what you do have is a little trickier. I do a lot of second opinions on that, and you get an Excel file that you can then use to update your own pie charts going forward. So it is a good idea to do that sooner rather than later. What I'm seeing in the markets is a general downtrend. Right now, mostly, I think this is professional traders who are selling off. I don't see a lot of Main Street selling off. I see a lot of Main Street confused and holding on. Wall Street is selling off, and that's something that is a little heartbreaking for me, because they're selling as high as they can. And if you wait to get yourself safe, protected, hot, and properly diversified, again, if you wait, then you might be selling low, and then that's not the time to do it. So what tends to happen with buy and hold financial advisors, and there's a lot of them still out there, even though it's a 20th century strategy that has not worked at all in the 21st century, is that right now they'll tell you, oh, well, don't sell now. You should be either buying on the bounce, or you should be hanging on, or you should be writing it out. And then when we hit the bottom and you're about ready to strangle them and you want to sell, they'll tell you don't sell low. At that point, they're right. At this point, they're wrong. Not writing it out, buy and hold, all of that is not a good idea right now, this early in the game. If we've already seen this kind of a correction this early in the game, and all of it is Wall Street insiders, it's telling you a lot. By the way, we've never seen this number of CEOs volunteer to leave this fast. And that's got a lot to do with them wanting to sell high. Basically, they have the ability to cash in more of their shares if they retire now. So you see Bill Gates, you saw Bob Iger, the Disney CEO, Hewlett Packard. So I'm just listing, 3 of the top ones. We've seen hundreds jumping ship. So I want to remind you that panic is not a good plan. Neither is market timing. Trying to jump all out, that's not a good plan. The nest egg pie chart takes the emotions out of it. It is a time-proven plan. It earned gains in the last 2 recessions. It has outperformed the bull markets in between. And annual rebalancing is a buy low, sell high plan on autopilot. So it's something that allows you to know what to do and also to sleep at night, because you know that you're properly protected from the downturns and properly diversified for the bull markets, and that you'll know what's safe, so you'll know what to do on that. So again, buy and hope has been losing more than half in both of the last 2 recessions. So that's not a strategy that works. And the reason that it worked in the 20th century is that the economy was, for the most part, growing. We had a big push after World War II because the dollar became the global reserve currency, and we had all these innovative new products that we could sell to the rest of the world. We still are an innovator nation. We definitely innovate in technology and artificial intelligence and a lot of things, but we are probably, we have lost the global reserve currency to a basket of currencies. We also have lost that China and Russia are now trading oil, and Saudi Arabia and some Middle Eastern countries using what's called a petro-yuan. So if you're not aware of some of these things, again, you don't have to be. That's the beauty of the pie chart system, is that it protects you. Right now, it's not hard to know that we're in cautious recessionary times. It's not hard to know that. So overweight's safe. But diversifying is always the right answer. And again, if you already have a plan that's properly diversified, then you might rebalance it if it's still got some big slices in there, or if some of your hot slices have gotten very thin, you want to buy more low. But other than that, you're in good shape. If you haven't yet adopted the pie chart system, then you're the ones that do need to do this. And I would say sooner rather than later. So 21st century budgeting and investing. Budgeting is going to be key, because clearly there's a lot of household debt. Otherwise, we wouldn't have 14 trillion in consumer debt. We wouldn't have everybody freaked out over 1 month of pay loss. That means there's a lot of people that are living month to month to month. So you need to know budgeting strategies for the 21st century. Big ticket items are the solution. Cutting out cafe lattes and avocado toast can save you hundreds. It might help, but it is definitely not the solution for a world that does not add up. So I have done a 3rd edition of the ABCs of Money. I've been, over the past week, typing madly to update everything and to include the coronavirus recession. And I do encourage you to read it. Also, if there is enough demand, I will do a pop-up retreat via Zoom this weekend. So we're going to put a flyer up tonight. If you would like to register, then I'll do it. It's up to you guys. It seems like there's a big demand for it, and I'm happy to do it. I think we need it, and I'm here. Okay, and we'll make it as much more affordable than the in-person ones, so that you guys can all do it if you wish. All right, I'm going to go to the questions that were already emailed in. I want to remind you guys that you can, I better get it going before they cut us off here on Zoom. I want to remind you guys of the resources available to you. So again, oh boy, I don't think I've put up the link to the ABCs of Money 3rd edition on the homepage yet. I will do that as soon as we get off. But if you go to Amazon, it's only available in Kindle. It will be a print edition available within a few days, but right now it's only available in Kindle on Amazon. So go to Amazon and just search for The ABCs of Money 3rd edition by Natalie Pace, and you should get it. Just make sure it's the 3rd edition. Also, of course, we have retreats. The next one, we're going to reschedule the one in April. That will still be happening in England, but it will be in late November. So the people that are registered for that one, you'll get more information on that. Also, we are moving forward with the June retreat in Santa Monica. By then, this should be over, fingers crossed. I have a son in Hong Kong, and things are already returning to normal there. And yesterday was the first time that China had no new cases of coronavirus. So hopefully all these drastic measures that we're taking will put us on the same track, and we'll get through it together. So that's the plan. If you want to, of course, I'm going to have an April teleconference. If you want to email in questions for that April teleconference, email them to info@nataliepace.com. When you post a comment or a question on either my Facebook or my Instagram or my Twitter, I try to use that either in the teleconference or maybe in a blog, or we might already have a blog that deals with it, or we can point you to the section of the new edition of the ABCs of Money that deals with it. And then again, I think that many of you should consider us doing a pop-up retreat this weekend. The sooner, the better. All right, so let me get to the questions here real quickly. The first question that came in was about an individual company, McEwen Mining. McEwen had a series of unfortunate events in 2019 that reduced its production. So the guy that was responsible for it, he just left yesterday. I believe it was yesterday. Rob McEwen still owns 20% of the company. He is, one of the most respected gold mining executives in the business. The other thing that bodes well for gold miners is that the price of oil has tanked, and all these miners spend a lot of money on oil and gas for their operations. So their costs have gone down. And additionally, the price of gold has gone up. So it should bode well for mining in general. McEwen Mining, again, it's a play on an individual company that's very small. Small caps move faster in either direction. So I believe in the company. I believe in the CEO because he's, got a time-proven track record. I think that gold does have some headwinds in the near term, but most people are predicting gold to do pretty well this year. Goldman Sachs has an 1,800 an ounce target for gold. So what we're seeing right now is, again, the liquidity. It's liquidity on the big level, governments, nations, corporations, very big corporations. So they're having to raise money any way they can. So that might create volatility, but the general trend line in gold is up. Again, always in investing in individual companies is taking on additional risk. And I'm not giving you a buy or sell recommendation. I'm reporting news and information that you can make your own choice about, but understand that whenever you invest in a small company or any individual company, it is higher risk. Okay, so another person had, and that person had sent me an article to read. I don't read articles by bloggers, and the reason for that is that in this particular blogger, no way, he's been a blogger since 2016, and he doesn't even list in his bio any credentials or expertise at all. Remember, I always tell you, grade your guru before you read anything that somebody says. There's no reason to read somebody's opinion if they've been blogging for 2 years and they have no experience. So just remember that can lead you astray. Jack wondered if there are any safe investments. Yeah, there are a lot of safe investments. It's something that we go over at the retreat for 1 full day. Also, I have an entire section on what's safe in the new edition of the ABCs of Money. It's in every edition of the ABCs of Money. It's just updated in the 3rd edition for today, but it's pretty close to the same stuff, which is not at all the same stuff that it was in the Great Recession. In the Great Recession, it was easy to get safe in bonds, and money markets were okay too. But this time around, not so good. Okay, this one comes in. My question is, if we have if they have the appropriate amount safe for their age and they're overweighting safe and they're managing that, should they be purchasing more cannabis and gold to refill their hot slices, which have taken a real beating this month? Jenny, that's a really good question. So before you refill a hot slice, what you want to do is you want to ask yourself if it's getting beaten up because of market volatility or something, liquidity issues, or if it's getting beaten up from fundamental reasons. So ask yourself about gold. Do we think gold prices are going to go higher or lower? Well, the predictions are that they're going to go higher. Usually in a recession, they will go higher. It doesn't happen bang, zip overnight. So that was another question that came in about gold. Well, okay, if the stocks went down, why didn't gold go up? It doesn't happen exactly that fast. What has to happen is that people start losing faith in the stock market. That hasn't happened yet. A lot of Main Street is still thinking that this is more like a flu. They're not aware that we're in a recession. That again, they're not going to get a headline on that until July, end of July. So, and we're not going to get the headline on the first quarter being a contraction until the end of April. This next one at the end of March is going to still show probably 2.1% range of GDP growth because it's a revision of the fourth quarter. So the bottom line is I do think that gold is going up. So I bought more. And with regard to cannabis, the companies are still double, triple, quadrupling their sales. I'm not seeing a drop off in consumer products like that or things that people need to there's a lot of people that use CBD oil for health reasons and medication reasons. I guess you could make a case for even cannabis and THC for medication reasons to calm nerves or anxiety. Some people use it instead of alcohol. Of course, not all of us use, some of us don't use either one, but there are some people that do use it. So I don't imagine that sales are going to fall off. The real question there would be, will there be a problem with supply? So for that, you really need to go to the forward outlook and also to the earnings call transcripts and listen to what the insiders are saying about it. I'm a little concerned about MedMen. I'm not as concerned about Aphria or Tilray. Tilray is still partnered with Anheuser-Busch Aphria, the former founder and CEO of Hain Celestial, is now the CEO of Aphria, and the former co-CEO of Whole Foods is on the board. So these are experienced product executives. It's the right people on the board. There's also a lot of other very reputable people on the boards of Tilray and Aphria. So I hope that helps. And we are at our limit of time because this one was a test for me. It is recorded, so you will be able to listen back if you so desire. And again, if you are interested in the pop-up retreat this weekend, let us know right away and we'll get you information on that. All right, thanks again for joining me today. And I will be following up with all of this. Again, it's just going to be easier because the demand is so high to do a pop-up retreat this weekend. So if that's of interest, email us with pop-up retreat in the subject line, and then we will get the information back to you as soon as we possibly can. Thank you very much for joining me today. And I will be here. I will be keeping you posted. I want everyone in this tribe to be strong because there's a lot of good work for us to do going forward. The 21st century is very different than the 20th century. And those of us that embrace the changes and move forward with the changes are going to be in a very good seat. And those of us that adhere to the last century ideas are going to have trouble. So I encourage you to get educated. And again, a lot of this information is in a $3.99 book, the third edition of the ABCs of Money. Thank you. And please do post a review when you download the ABCs of Money. Obviously, because I am talking about things that a lot of people don't want talked about yet. They want it talked about at the end of July. A lot of buy and hold financial professionals, and there are multi-millions of them. It's a multi-billion-dollar industry. It's probably a multi-trillion-dollar industry. They don't like it either. So they post crap reviews on my book because they don't want people to have this information. So your review is gold, not just to me, but to others that need this information. Thank you, thank you, thank you in advance. And I look forward to speaking to you soon. And thank you for joining me today. All right, gang, I'm going to sign off now.